We'll go to profit margin now. So talk about profit margin. We're talking about the net profit. That's profit for the year. The formula is net profit divided by revenue multiplied by 100. I think that is clear. So using the financial statement shown in the work to calculate our funds profit margin. So we check the profit for the year. Let's see. Profit for the year. Profit for the year is 15,000. Then we check the revenue, which is 120,000 multiplied by 100. I think that is done.
Yes.
Okay. So it said this ratio shows the profit earned for every $100 of revenue. The higher the return, the more profitable is the business. The ratios act as an indicator of how well a business is able to control its expenses. If the profit margin of a business increases, it's difficult. It said if the profit margin of a business increases, it indicates that the operating expenses are being controlled. So the ratio will be influenced by, is that this ratio acts as an indicator of how well a business is able to control its expenses. If the profit margin of a business increases, it indicates that the operating expenses are being controlled. This ratio will be influenced by the different types of expenses. Some expenses increase in proportion to the sales, like commission paid or sales made. But other expenses remain the same, whether the sales are changing or not. So any change in the gross margin will also affect the profit margin. So for net profit margin, for gross profit margin, when you are calculating gross profit margin, it will only reflect on how you are able to reduce your cost of production.
Yes.
But for net profit margin, it reflects on net profit margin. So net profit margin is the profit for the year divided by the revenue multiplied by 100, based on what they said there. What is the difference between using profit margin, net profit margin, and gross profit margin? For gross profit margin, it reflects on our cost of production. So if you want to continue to increase your gross profit margin, you have to reduce. Is either you start increasing the price of your product, you buy cheaper raw materials. That is how you can increase your gross profit margin. But for net profit margin or profit for the year, it does not talk about the cost of production. It talks about how you are able to reduce your expenses. So if your expenses are reducing, it might help your net profit margin. Though if you're having a falling gross profit margin, it will affect also your net profit margin. But net profit margin is only talking about, most of the time it's talking about how we can curb our expenses.
Meaning?
So for net profit margin, it's talking about it calculates it investigates how we are able to reduce our expenses as a business. So if our expenses are reduced, it will increase our net profit margin. So how can you do this? One, you have to think about how your spendings on income, like how you are able to reduce your spendings on maybe commissions that you give to customers, or even commissions that you pay to even your maybe your employees, or commissions you pay to other clients because they help you to sell maybe some products. So whatever expenditures you have to reduce, you have to cut your cost. I mean, you have to cut your overhead cost.
Or ordinary, what's it called?
What?
We took it last time. Ordinary. The one that talks about shareholders. Ordinary something.
What shareholders? Dividends.
Yeah,
you can't do other shareholders. Yes. No. How can you for other shareholders? Yes, you can pay their dividends later. But if you don't pay dividends to shareholders,
I mean, ordinarily you can less it, so you can have more profit.
Yeah, but here we're talking about expenses.
Yes.
But paying dividends, dividend is part of expenses, but it's not an expenses that you can cut. You're talking about return on investment for owners of the business. If they are not making, if the business is not making profit, they will sell off their shares. They won't have interest in the business anymore. So you shouldn't just even think about cutting dividends, especially for private shareholders. You shouldn't. Good. So what you have to understand here is that for the net profit margin, you need to investigate your expenses, your overhead expenses as a business. That is the point there. So here it said, so to improve the gross margin, the gross margin can be improved by measures. Okay, we talked about that. So we go to the net profit margin. So what do we do about how can we improve the net profit margin? One, by increasing the gross profit margin. So if you have to increase the net profit margin, you have to increase the gross profit margin. So how do you increase the gross profit margin? You can increase the gross profit margin by increasing the price, finding cheaper raw materials. But these two has a cost. The cost of selling at a higher price is that you might be losing customers. The cost of buying cheaper raw materials is that you might be producing poor quality products, which means you can also lose customers. That's how you can increase the gross profit margin. Now, the second way that's how you can increase your gross profit margin, which will reflect in your net profit margin. The second point is controlling expenses. So you have to reduce your expenditures because you have to cut your cost of office overheads. By so doing, you'll be having more income. The third point is increasing other income. So start thinking about how to make more, how to sell more. Start thinking about how to make income from whatever source. Diversify.
Yes.
Give more services that will generate more income. Do you understand? So these are the ways in which you can increase your net profit margin. So when there's a fall in the profit, when there's a fall in the net profit margin, what are the reasons why we might have a fall in the net profit margin? Number one, a decrease in the gross profit. So if the gross profit is decreasing, the net profit will decrease. Two, because it's a reflection of the net profit. Because net profit is gross profit minus expenses.
Positive relationship.
They are direct relationship. So gross profit, net profit is gross profit minus expenditure. So if the gross profit is less, when you less it from revenue, it will become lower. Two, and increase expenses. So you have to check your expenses. If you are incurring more expenses, it will affect. The third point is when there is no income for the business, it will also affect. And the last one is the change in the type of expense. So when you are changing the type of expenses you have, it might affect your business. I think that is clear. Yes. So we go to liquidity ratios. So when we talk about liquidity, we're talking about the measures that are made. We're talking about how often the business can have cash. That's liquidity. Do you understand? Yes. How often the business can turn cash into assets to cash. Because when the business is not liquid, when the business doesn't have liquid, it means the business does not have cash flow. Do you understand? Yes. So here in business, the term liquidity relates to money, and liquidity ratio measures the ease and speed with which assets can be turned into cash. That is liquidity. So we have current ratio, which is current assets divided by current liabilities. I think it's clear. Yes. Current ratio is what? Current assets divided by current liabilities. Clear? That's clear. So they said this is also referred to as the working capital ratio. It compares the assets which are in form of cash or which can be turned into cash relatively easily within the next 12 months with the liabilities which are due for repayment within the period of time. So this measures the ability of a business to meet its current liabilities when they fall due. So we already know what current ratio is, right? Current ratio is current asset divided by, which is same as working capital ratio. So why do we need them? They said the working capital of a business must be adequate to finance the day-to-day trading activities. A business which is short of working capital may encounter the following problems. So what are the consequences of a fall in working capital? Number one, you cannot meet your immediate liabilities. When they are damaged, you are not going to be able to pay your credit customer or supplier. Are you getting it or not? Are you there or not? No.
Before the points. Didn't get like so.
Okay. For working capital ratio, it is the same as current ratio, which is current asset divided by current liability. We're talking about liquidity. Liquidity means the flexibility of how easy it is for assets to be turned into cash, especially current assets to be turned into cash. That is liquidity. Then for liquidity ratio, we have one of the liquidity ratio we have is current ratio, which talks about comparing your current assets with your current liabilities. Your current assets are those things those assets you have that can last within a year. Yes. When you compare it with your current liabilities, those ones that you have to pay within a year. So that is current, that's working capital ratio or current ratio. So what are the problems when you have if your current asset is more than your current liability, then it's fine for the business. That means the business will have more cash flow. You get the point here?
Yes.
But if your working capital ratio is falling, then it becomes a problem for the business. What are the problems that the business might encounter if your working capital ratio is becoming less? One, it means that you won't be able to pay your current credit suppliers when it's due to pay. That's the first one. Look at what they said. They said the working capital of a business must be adequate to finance the day-to-day trading of the activities. So a business with a short current ratio may encounter the following problem. One, you won't be able to meet up with credit suppliers. You won't be able to pay them when it is due to pay. And that will also increase your interest because you have to be paying interest on those amounts you are owing your credit suppliers. Two, experience difficulty in obtaining further supplies on credit. Because you didn't even pay for the previous one, how do you get a new one? You won't be getting new credit supplies because the previous one you've not paid for.
You need to pay to get on. Yeah.
They won't even trust you. The third one, you cannot take advantage of cash discounts. It means you have lost out in cash discount because you get cash discount when you are able to pay before the due date. But because you don't have the cash to pay, that means you won't have any discount when you have to pay back.
And there might be an interest.
Yes. And the fourth one, cannot take advantage of business opportunities when they arise. That means whenever there's any business opportunity, whenever there's any opening in terms of maybe businesses that you can start, you can't have the advantage to take it up because you don't even have the cash to do it. So how can we improve our working capital position? Number one, you introduce further capital by owners. You sell maybe shares.
Yes.
You have to find new owners. Two, obtain long-term loans or not. You obtain long-term loans. That is, you get loan, long-term and not short-term, not overdraft. It won't help you.
Yes.
The third point, selling surplus. Selling surplus non-current asset. That means you are selling those non-current assets that you are not using instead of them to become obsolete. Or maybe you have two motor van and you are only using one is only active, the other one is just there. You wasted. So you can sell it to have cash. Yes. It increases your working capital. The fourth point, you delay purchasing of non-current assets. You stop or you cancel or you stop or you delay buying non-current assets like equipment or machine. Because when you buy non-current assets, it takes away cash from you. So you can delay the purchase of non-current assets.
Yes.
So these are the ways in which you can improve your working capital. Number one, you introduce further capital, means you find new owners. Two, you obtain long-term loans. Three, you sell those non-current assets that are wasted, that you're not using. Yes. And the last one is you delay the purchasing of non-current assets.
There's no increased profit.
Yes, okay, yes, increased profit. No. Increased profit is also part of, yes, if you are increasing profit, it will add up to your capital. Yes. So reducing drawings, yes. If you are reducing drawings, it means you stop taking money from the business. Yes. That means the money will stay with the capital will stay with the business. I think it's clear.
Yes.
So that's about current ratio, which is the same as working capital ratio, and the formula is what? Current asset divided by current liability. That is done. Then we go to liquid asset ratio. For liquid asset ratio, we are talking about current asset minus inventory divided by current liabilities. That's the formula. Current asset minus inventory divided by current liabilities. Are you with me?
Yes, yes.
Okay. So, I said the liquid asset ratio compares the assets which are in the form of money or which will convert it to money quickly with the liabilities which are due to be for repayment in the near future. This is a similar calculation to the current ratio, but the liquid asset excludes inventory as this is not regarded as a liquid asset. For liquid assets, they believe inventory because they are not yet sold. They don't consider them as assets. They don't consider them as money, as cash. Yes. Do you get what liquid asset is talking about here? Liquid is cash.
Yes.
But we are talking about our current assets, which involves cash, bank, inventory, and trade receivables. But for current asset, in liquidity ratio, we only deal with trade receivables, cash, and bank. We exclude stock or inventory, because in liquid asset, in liquid ratio, inventory is not considered as money
Yes.
because it's not yet sold.
Yes. No. Yeah.
So the formula is current asset minus inventory divided by current liabilities.
Yeah.
Clear?
Yes.
Any question about that? So here they said, okay, the liquid ratio compares the asset. Okay, ratios between 0.7:1 and 1:1 are usually regarded as satisfactory. But as with the current ratio, the size of and type of business should also be considered. A ratio 1:1, a ratio 1:1, indicates that the immediate liability can be met out of the liquid asset without having to sell inventory. So
You get what's 1 and 1 0.
yeah, if you have your current assets,
Mhm.
when you minus your current asset from your inventory,
Yeah, minus inventory from the current.
and is lesser than
the liability.
your current liabilities,
Yes.
it is still fine.
It's fine.
Yes, it's fine. This is, look at, we have 0.7 to ratio 1.
Mm.
So 0.7 to ratio 1 means that you
From
are
0.7 to up, that's fine.
it's fine.
But from 0.7
0.7
to
downward, it's less.
not,
It's
yeah.
not good.
Yes, I get it.
Do you understand? Because I think it's satisfactory. It means, okay, when we sell our stock, we'll be able to meet we'll be able to reach the same level.
It's because you don't have the inventory. If you do have the inventory,
Yeah.
yeah.
But if it is 1:1, it
One.
means that what you have right now can pay for
Liability.
the liability. That means you are doing well.
Without the inventory.
Without the inventory, it means you are doing well. Do you get the point
Yes,
now?
yes, I get it.
Okay. So we'll move on. So we go to rate of inventory turnover. Are you there?
Yes.
We talked about rate of inventory turnover before, I think. I think I said cost of sales divided by average inventory. And average inventory is what? Opening inventory plus closing inventory divided by 2.
Yes.
Remember we talked about
Yes,
it.
yes.
So let's go to rate of inventory turnover. Are you there?
Yes.
So for rate of inventory turnover, it is cost of sales divided by average inventory. And another way to calculate it is average inventory divided by cost of sales multiplied by 365 days.
Which is 1 year. Yeah.
Yeah, this is when you are talking about the rate. How many days does it involve for your stock to be sold and get a new one? Do you understand rate of inventory turnover now? You buy the inventory, you buy your stocks. How long does it take you to sell them, to return down, to sell them and to have them reordered?
So it's not about percentage, it's all about days.
Days, yeah.
Yes.
Is it clear? So the formula is there: cost of sales divided by average inventory, or average inventory divided by cost of sales multiplied by 365. Either way, you get the same answer.
Mm.
Is it clear?
Yes.
So here we have, so using the financial statement shown, okay, calculate Arun's rate of inventory turnover, the number of times in the year inventory is replaced, the number of days inventory is held before being sold. So we have these figures. Where do they get these figures from?
Also, the first formula is about times. Second formula is about days.
Yeah, both of them are time. Time and days, what's different?
Yeah, because yeah.
It's not about, the only thing is it's not percentage.
It's not percentage, yeah. It's all about times and days.
Days, yeah. So here we have said, which questions are they using here? Where do they get this information from? I don't know where they got the information from. Let's see.
From the first one.
Okay.
From safety.
Okay then. So they said 96,000. That's cost of sales. Yeah, cost of sales divided by opening inventory plus closing inventory divided by 2. This was 12 times.
Yeah.
Or cost of sales. No.
Yeah. Average inventory.
Average inventory. Yeah, sorry. Average inventory divided by cost of sales multiplied by 365 days. I think that is clear.
Yes. But then, Mr. Why is it? It said 30 days, 0.42.
It's equivalent to 31 days.
If you round it up, it's not 31.
Yeah, but you could. It's more than 30 days.
It's more.
It's more than 30 days. You wouldn't call it 30 days anymore.
Mm-hmm.
Do you get the point?
Yes, yes, yes.
Yeah, that is max. But here, it's roughly 31 days.
Okay.
Do you get it?
Yes, yes.
Because if it is 29 point something, you say it's 30 days.
Yeah, I get it. Yeah.
Okay. So here we said the quicker the rate of inventory turnover, the less time funds are tied up in inventory, which is regarded as the least liquid of the current asset. So the rate of inventory turnover I'm reading the last paragraph. The rate of inventory turnover can affect the profit of the business. If the business activity slows down, both the gross profit and the profit for the year will be adversely affected. So a lower rate of inventory turnover can be caused by factors such as, so what they're saying is this: if your rate of inventory turnover is less, you won't be making profit. That means your profit will, the rate at which you make profit will be less too, because your profit is based on how fast you are able to sell your inventory. You get it? So, what are the problems when you have a lower rate of inventory turnover? Number one, lower sales, which means you have high inventory levels. That means you have a lot of stocks, which is not good. They could get expired. Two, inventory over purchased. That means you've bought more inventory than what you imagine that you can sell.
Supply over demand.
More supply than demand. Yeah, thank you.
Yes.
The third one, too high selling price. That means you are selling at a higher price that customers cannot afford. So they are not buying from you. Maybe they are buying from competitors. Falling demand. So demand fell. Here we're talking about causes of low rate of inventory turnover. So they might ask you in the exams, what are the causes of low rate of inventory turnover? What are the reasons why we could have low rate of inventory turnover? If the price is high, rate of turnover will be less. If you are selling, that means the price. If your gross profit is less, you won't be that means the demand is low. If your revenue is less, low sales, it will affect it.
Yes.
If business are going slowly, if business activity are not, maybe economic activity are not afforded, it will affect your rate of turnover too.
Yes.
Business inefficiency, if you are not doing well as a business, if you are careless as a business, it will affect your sales. So that's about that. So we go to trade receivable turnover. We're talking about our credit customers.
Yes.
The turnover of our credit customers. So how do you calculate it? It is trade receivable divided by credit sales multiplied by 365. You just have to, there are things you will know. There are things that you have to know there. They are easy, right?
Yes, I'm getting it.
For inventory turnover, it is your inventory. That's clear, right?
Yeah, that's clear.
For trade receivable turnover, what is trade receivable? Our credit customers, right? So we talk our credit customer. We're talking about our credit turnover or customers turnover. It will be the total number of credit per customer divided by the credit we sold multiplied by 365 days.
Yes.
I think it's clear.
Yeah.
Yeah. So here they said, alternatively, you can say trade receivable credit sales times 52 weeks. That's 52 weeks. It's still the same.
Weeks and months you can do, yeah.
Yeah. So it is, if you want to use days, you use days. If you want to use weeks, you use weeks. If you want to use month, you use month.
Yes.
So I think it's clear.
Yes.
For trade receivable turnover, it is trade receivable divided by credit sales. If it is monthly, 12 months. If it is weekly, 52 weeks. If it is year or daily, 365 days. Clear?
Yes.
So using the financial statement, okay, we have this. So these are trade receivable divided by the total number of sales we sold on credit, multiplied by 365 days. So I think it's clear.
Yes, yes.
Okay.
Let's see the.
So they said this may also be referred to as sales ratio. It measures the average time the credit customer take to pay their accounts. The answer to this calculation, the length of time credit customers actually take to pay their accounts, should be compared with the time of credit allowed to them. The quicker the customer pays the accounts, the better it is. The money can then be used for other purposes within the business. The longer a business has to wait for a debt to be paid, the greater the risk of it becoming irrecoverable. So for trade receivables, it's the same as sales ratio, which means the rate at which the time lapse between customers buying on credit and paying. That is about sales ratio. So now they said if the rate the trade receivable ratio is high, it is good for the business because the business will be able to have cash available to do other things. But if the trade receivable ratio is low, it affects the business because the business will be short of cash, and even the debt can become irrecoverable.
How is that? Let me get it. I mean, trade receivable is not good for the business, right?
No, you sell on credit. It's not a problem. Being able to retrieve,
yeah, that's
is an asset to the business. Trade receivable is an asset.
Yes, I know you sell them on credit, but you didn't receive the money, the whole amount of the money.
That's why they said if there is high rate of return on trade receivable, it is good for the business. Because yes, high rate of return.
Yes,
it means credit customers are paying as at when due.
Yeah.
So money will be available, cash will be available for the business to do other things. But if it is low, it affects the business
Yes.
because the business will not have cash available to do a lot of things. And even the debt can go bad.
Only if they have provision. That's all. Provision.
If you have provision, it's a bad debt. You have provision.
But you.
It's a bad debt. You're not getting the money. You are paying for the money.
Yes.
It's bad. It goes bad. Making provision is just like you are keeping money aside for the waste that is not coming. It's not. It's still your money. It's still.
Yes, still the money. Yeah.
So
Still
the
lost,
debt,
yeah.
the one thing about it is that the debt has gone bad.
Yeah. That's it.
So they said the same business may have a similar trade receivables turnover from year to year. If the period decreases, it may indicate that the credit control policy is being applied more effectively. If the period increases, it may indicate that the credit control policy is inefficiency, or that longer credit terms are being allowed in order to maintain the quantity of credit sales. So the rate of trade receivable turnover can be improved by measures such as one. I talked about that already. That you need to check if trade receivable turnover is high, it's good for the business, but if it's low, it's bad for the business. So how can you improve on your trade receivable? Number one, improve credit control. That means you improve the credit control. How you give credit to customers, you have to improve the way you do it. Like you control it. You don't just give credit every now and then. You check what you are doing. That's the first one. Maybe you reduce it. Two, offer cash discount for early settlement. So instead of selling, yes, you sell on credit, but give them cash discount to make them come and pay as early as possible. The third one, charging interest, like I told you earlier, if you don't pay early, you pay interest. Charging interest on overdue accounts.
Yes.
So when credit customer knows that they have to pay interest on due payment, maybe they will pay earlier.
It's because they will be afraid of that.
Yeah. Four, refusing further supplies until any outstanding debt is paid. Refuse further supply.
It's the same point.
Yes.
Reverse. Yeah.
Invoice discounting and debt factoring. Here we're talking about allowing businesses or firms that are specialists in retrieving debt to buy the invoice from you. You don't get it? No. Invoice discounting means, or debt factoring means, you are allowing someone else that likes to buy debts of businesses, debts of customers to buy it. So you are owing me $5,000, yes, which you are supposed to pay now, but you are not paying.
Yes.
So a business can buy that $5,000, can buy your invoice. You know, it's an invoice you have. So I would say I could sell it to that business for $4,700. So the business will be the one chasing you to pay the $5,000.
Oh yeah.
That's debt factoring.
Yes, I do.
Do you understand?
Yes.
So go to trade payables turnover. Trade payables turnover is trade payables divided by credit purchases.
The opposite.
Yes, I think that is clear.
Yes, sir.
So they said the same business may have similar trade payables turnover from year to year. If the period decreases, the business is paying the suppliers more quickly. If the period increases, it will indicate that the business is short of immediate fund. So here, the difference between trade payables here is that if your return on trade payable is reducing, it's good because it means you are paying often. You are paying your credit customers as soon as possible. Do you get the point?
Yes, sir.
So that means you are paying your suppliers as fast as possible. But if it is increasing, then there's a problem. It means you don't have cash to pay your credit suppliers, yes, which means something is wrong with your business. I think it's clear. Yes. So taking longer to pay the suppliers means that the business can use the fund for that purpose, but there can be adverse effects such as another way to listen. Delaying payments to your suppliers is another method to improve your cash flow.
Delaying payment.
Yes. You don't get what I'm saying? When you are paying, what I'm saying is, when you are paying your customers, when you are paying your credit, or when you are paying your customers, what I'm saying is this: when you are paying your credit customers or your suppliers, If you have to pay your suppliers, you have to pay them as at when due. If your trade payable ratio is less, it means that you are paying your suppliers as soon as possible, which is good for the business. But if your trade payable return is high, it means you don't have cash available to pay your credit suppliers, which is bad, is a bad thing for the business.
Yes.
But one thing is this: for a business to improve its cash flow, that means the flow of cash. For a business to improve it, it might need to delay payment to credit suppliers. So when you delay payment to your credit suppliers, it means you are not paying them when it is due. That is what I'm talking about here. Do you get the point or not?
Yes. But they will get interest or something like that.
Yeah, it has a consequence.
Yes.
It has a consequence. But the point we are making, what we just wanted to know is that
there will be cash flow. Yes.
there will be cash flow.
Yeah.
I think it's clear.
Yes.
All right. So okay. Okay. So for that, trade payables, okay. So it says supplier, okay. Suppliers refusing further supplies. Okay, we talked about that. The loss of any cash discounts for early settlements. These are the problems you encounter when you delay payment, when you are not paying your suppliers. One, your suppliers will not trust you. You won't be getting a new one from them. It damages the relationship between you and your suppliers. It damages the relationship. They wouldn't trust you. And also, you will lose out on cash discounts because you're not paying as at when due, and you have to pay interest. Clear?
Yes.
So go to interfirm comparison. Are you there?
Yes.
So when about interfirm comparison, that means you are comparing business A with business B based on their financial results or financial analysis.
Yeah.
So it said comparing the ratio calculated for the current financial year with those of previous years can measure the progress and performance of the business and indicate the trend in profitability, liquidity, and so on. Okay, another useful comparison is to compare the ratios with those of similar businesses, which are competitors. Aaron is a trader who has been in business for several years. Renu started a similar business in another town 2 years ago. The financial year of both business ends in 31st of December. Renu allows access to our financial accounts. So these are their financial analysis.
Yes.
So they said for each business, calculate the following ratios: return on capital employed. So return on capital employed for
it's, first profit of the year without interest divided by capital employed.
Capital employed. But what's the capital employed?
Capital employed is
capital plus non-current liabilities. So do that. You can compare.
Capital employed. It's already there.
So
last one.
Okay, let me see. Okay, down. Okay. Down. This is how they do it. So you compare A and B. So
what's that?
Gross profit, you know that? Profit margin, current ratio.
Where's the profit?
Profit is there.
The
profit is there. You have this is the income statement. You have the income statement and the statement of financial position together. This is the final account. You have your profit. Do you know how you get your profit now?
Yeah, I get the profit on my own. Okay.
They did everything already.
Yeah. There's incomplete records.
Where?
Cash sales, cash.
Cash sales,
yeah,
credit sales.
Cash sales and revenue.
Yeah, here they said cash sales and credit sales. When you're calculating your revenue, it is 120. But when you have to calculate for trade receivables,
120, 110.
120 revenue is 120.
Oh yeah.
Listen, why they make the analysis like this is this. You might need to calculate for trade receivables. Rate of trade receivables.
Yes.
For calculating trade receivables, you cannot calculate all the revenue. You have to calculate credit sales.
Credit sales, yeah.
That's why you have it separately.
I mean, revenue doesn't have cash sales.
Yes, it's okay. It doesn't have. She doesn't have. What will you do?
It's incomplete, or is it doesn't?
It's complete. It's the total revenue.
She doesn't have it. Yeah.
So this still becomes its total revenue.
Yes.
It is when you want to calculate your trade receivables, rate of trade receivables, that you think about credit sales separately from cash sales.
Yes, it's a good thing.
How is it?
Trade receivable over cash sales.
Credit sales
times
Rate of inventory turnover. For rate of inventory turnover, it is total sales, you know. Rate of inventory turnover.
Yes.
Cost of sales divided by
Yeah. Cost of sales
divided by revenue.
Average of inventory.
Cost of sales divided by average inventory.
Yeah.
Multiplied by
100.
yes.
Oh no. Multiplied by 100 or 35.
365 days.
Yeah, 65.
That's done. What else do we have there again? Trade payable turnover. That is known.
Yeah.
Liquid asset test is current asset minus
divided by
current asset minus inventory.
Wait. Liquid.
Current asset minus inventory divided by current liabilities.
Current ratios, current.
Yeah, so everything is done there.
Yes, yes.
Okay.
I did it without looking for it.
Yeah, that's fine.
Yeah.
So let's go to problems of interference comparison. Are you there?
Yes, yes.
So for problems of interference comparison, when you are comparing two firms, they said a business can often obtain valuable information by comparing the accounting ratios with those of another business. But the business must be aware of the limitations of such a comparison. Every business is different and has different requirements and accounting policies. A comparison is only meaningful if it is between two or more businesses of the same type, of the same size, and in the same trade. The problem of comparison includes the following. So it becomes meaningful only if you're talking about comparing businesses that are of the same size, the same business, and they have what else do we say? They do the same thing. So their size, the kind of business they do, and the kind of what they produce are the same. So if not, it doesn't make sense.
Yes.
You just comparing schools, like you're comparing Mukta International School with maybe no, it's still good. They are almost the same level. Mukta International School with maybe Passion or Passion International School, a small school like that.
Yeah.
It's difficult. That's what they're saying there. So what are the problems we can encounter? Number one, the business may apply different accounting policies. For example, they may use different methods of depreciation. So the problem of comparison is that one, it is accounting, yes, but business A might be using straight line method for depreciation. Business B might be using reducing balancing method of depreciation or revaluation. So that means they won't get the same answers. Two, the business may apply different operating policies such as renting premises, purchasing premises, or paying long-term loan. So the business may have different ways. Business A might have its own premises, which means it's not paying premises. Business B might not have, which means business B will have rent payables.
That's what we saw at the previous exam.
Yes. So they compare. Yeah?
When I said it's incomplete.
Yes, it's incomplete. Like a business is selling on credit, the other business is not selling on credit. So it will not give you accurate figures. Third one, non-monetary items such as skills of workforce, the goodwill of the business, and so on do not appear in the accounting records, but are very important in the success of the business. Business A might be having, Mukta might be having maybe the best teachers, and the other school is not having good teachers. It will affect.
It's non-tangible assets.
And they are non-tangible assets, but it will reflect in the business.
Goodwill and
reputation. Yeah. So it is not always possible to obtain all the information about another business, which is needed to make a true comparison. You can have all information of your business, but it's difficult to find all information of another business. Something will be missing.
Yes, yes.
So one way or the other, they might directly or indirectly remove it. So you don't have detail. You don't have detailed information.
Maybe their statement is not correct.
No, it will correct. Something might be missing. That's the point. I think it's clear.
Yes.
So the information related to other business may be for one financial year only. So it is not possible to calculate business trends. That particular year may also not be a typical year. So if you are comparing this business now, business A and business B, maybe this year business B does not do well, but maybe last year it did well.
Yes.
So you won't be able to judge business B based on this year alone, because history says it does well last year. Maybe it's going to do well next year again. Do you understand? So it's difficult to compare.
Yes.
The financial year may end in different dates, which means it might be in a season that maybe at the end of the year, maybe your financial year ends in September. Maybe my financial year ends in December. So how do we compare? My own is going to end in December. So that means I might still make more sales than yours that is ending already. And by December, you are already in a new financial year. So it's difficult to compare. Is it clear?
Yes.
The accounts are based on historic cost and do not show the effects of inflation. So whatever we record here on historic cost, that means it does not have inflation does not reflect on us.
Mm.
But inflation is part of what we do because it will affect our operations in the long run.
Yes.
Do you get it? So we go to users of accounting statements. Are you there?
Yes.
So when you talk about users of accounting statements, we're talking about users of financial statements. Who are they? Number one, we have owners. These are internal users. We have owners. Why do they need financial statement? They want to be sure about the profitability of the business.
They can invest
If
more.
they can invest more and how progressive the business is.
Yes.
So that will tell them to continue with the business or to sell off their shares. For owners. Managers, it measures their performance. If they are doing well, because if the financial year is fine, it reflects in the activity, it reflects in the performance of the managers. So that means the managers are doing well, and that can also improve their CV. And that might also make them to increase their pay. That is managers. Is it clear?
Yes.
For external users, bank manager, why do they need your financial statement? They want to be sure that you are credit worthy. If they have to give you loan, they want to be sure that you will be able to pay back. They want to be sure that you don't have outstanding loans with other banks. Clear?
Yes.
Other lenders, anyone who has made a loan to a business will be interested in the security available. The payment of the loan when due and the payment of interest when due. So other lenders are those that you can borrow from too. So they want to be sure that you have security, that they want to be sure that you have the credit worthiness to pay back. Trade payables, your credit suppliers, why do they need to know about your financial statement? They said anyone who has supplied the business with goods or credit is interested in the liquidity position and the trade payables turnover. These factors may be considered when determining the credit limit and the length of credit allowed in practice. It may not be possible to obtain the accounts of sole trader and partnership businesses. So other means of checking credit worthiness are employed. For trade payables, they want to be sure that you don't have a lot of credit suppliers, and they want to see your cash flow, because your cash flow will determine if they are able to give you supplies, or if they can give you and you pay when it is due. But for sole traders and partnership, they might not be able to access it because you don't prepare a financial statement. So they can use other measures, like you find by telling sole traders to get a reference from their credit suppliers. Sole traders, we have former credit suppliers they buy from.
Yes, yes.
So businesses or suppliers might tell them to get a reference from their credit supplier, their previous credit suppliers, to be sure that they are good credit customers.
Yes, yes, yes.
Sole traders do not prepare financial statements. Even if they prepare it, you cannot have access to
You
it
want to see the history of
because it's not published.
It's all about history of the business with other suppliers.
Yes.
Previous suppliers. Yeah.
Is it clear?
Yes, yes.
Potential buyers of the business. Why do they want to have your financial? Why do they need your financial statement? Anyone with an interest in purchasing the business or making a takeover bid will be interested in the profitability of the business and the market value of the assets on the business. So they want to be sure that there will be return on their investment. That if they are putting their money here, the return on investment is high. That means the business will be able to make profit. They want to be sure that there's more assets than liabilities before they buy. Customers, they want to be sure that you'll be able to supply them every now and then. They can count on you. Not that when you supply this week, you won't be able to supply them next week, because that means they're going to disappoint their own customers too. So they want to be sure that you are consistent with your supplies.
Yes.
Government departments. Government department may want employees and trade unions. Employees and trade unions want to know that the company is able to continue operating and so maintain jobs and continue to pay adequate wages. In some cases, contribute to pension schemes. For employees and trade unions, they want to be sure that the company is for the long term and the company has that financial capability to pay them their wages whenever it is due.
Yes.
For government departments, government department may want information for purpose such as compiling business statistics and checking that the correct amount of tax is being paid. So for records, for taxes. Club members, the members of a club society want to know that the club is being well managed financially, so that it will be able to continue in existence and provide the facility to members. So for club members too, they want to be sure that they don't want a profit-making organization, but they want to be sure that they have the financial capability to continue running the club for as long as possible, and they have the financial capability to invest on club facilities.
Yes.
So what are the limitations to accounting statements? Number one, time factor. The accounting statements are a record of what has happened in the past, not a guide to the future. So additionally, there's a gap between the end of the financial year and the duration of the accounting statement. So in that time, significant event, in that time, significant events such as changes in inventory levels and purchasing of non-current assets may have taken place. So the first problem, the first limitation or problem about accounting statement is that there's time factor. The time at which you prepare your financial statement is based on records in the past, from December till now. It becomes past, yes or no?
Yeah, absolutely.
But what happens when you are preparing your statement of financial position? Things would have changed at that time. Figures would have changed. Do you get it or not?
No.
When you are collecting records, you are collecting records from the past to prepare your financial records, right?
Yes.
So, in the course of you collecting these records, things that you have calculated for in the past, when you have to calculate them again now, it will not reflect the same price. It would have changed with time.
Yes, inflation in this thing.
Do you understand?
Yes, yes.
So there is changes in everything. Maybe the prices of inventory has increased.
The currency and this thing. Yeah.
So this thing will affect
Yes.
when you are preparing your financials, your final accounting statement. Do you get the point I'm making here? So there's always a time factor. Is it clear or not?
Yes. Yes.
Do you get it or not?
Yes, yes,
The financial year must end before you prepare your financial statement. So in the time of you preparing your financial statement, whatever adjustment that happens will affect it.
Yes, I get it.
The second point, historic cost. The only way to record financial transactions is to use the actual cost price. However, comparing transactions taking place at different times can be difficult because of the effect of inflation. For example, in times of inflation, it will cost more to buy a machine identical to one purchased in 2018 to that in 21.
Yes.
So the cost will be different. So to affect it. Accounting policies. They said all businesses should apply the accounting principles of prudence and consistency. We should help in making comparisons. However, there are several acceptable accounting policies which may be applied. For example, there are several different methods of calculating depreciation. Yes, in accounting concepts and conventions, there must be prudency, there must be consistency. But when you are calculating depreciation, there are different methods you can use. So this can also affect the accounting statement. Different definitions. Where a business has borrowed money, for example, in the form of loans or debentures, the income statement may show the profit from operations and then deduct the finance costs to give the profit for the year. Another business may not show this distinction. Businesses may use a different definition of profit when calculating profitability ratios. So a comparison of profit and profitability ratio is only meaningful if like is compared with like and the same definitions are applied. So what they are saying here is this. So businesses might pay profit. Some might think their profit is, some might not think about profit after tax or profit after interest. Some might not even have profit after interest because they don't take a loan. You might be thinking about profit before interest.
Yes.
I might be thinking profit after interest.
Yes.
I might be thinking profit even without interest. So our definition of profit are different. So because our definition of profit are different, it means our comparison of profit will be different.
Yes.
We are talking about problems about different limitations about financial statements. So we've talked about time factor. We've talked about historic cost. We've talked about accounting policies. Now we're talking about what did I talk about now? Different definitions, the meaning of the definition of what we give to our accounting terms, like profit. There's profit in gross profit, there's profit in net profit. The net profit could be profit before tax. Some people don't pay taxes, they have profit, they make profit. Some people do not have loans on interest, they have profit. Some people have income that adds to their profit. So different things will happen. So if you have to compare business A with business B, business A must have the same definition of profit that business B has.
Yes, it's a good thing.
That is the different definitions. Money measurements. Account only record information which can be expressed in monetary terms. So this means that there are many important factors which influence the performance of a business, which will not appear in the accounting statement. So the factors which are within the control of the business include the quality of management, the skill, the reliability of the workforce, the goodwill of the business, the age and the condition of the non-current assets, and the ability to adapt in response to changing market conditions. Other factors are outside the control of the business. This includes, we call them external factors. Okay, so the ones that are internal factors, like the type of workers you employ, the investment you make on equipment, the investment you make on machinery, the time you want to close your shop, the time you want to open it, the financial year, the policy, these things you can have control over them. But the external ones, you can't have control over them. So those external ones can also influence your financial statement. Because if government comes up with different policies, maybe government can increase taxes. What can you do about it? It will reflect. Do you get it? So technology latest technology advancement, you can't have control over it. If they are latest technology, you have to buy them.
Mhm.
Maybe at a cost, then you have to buy. Then that reduces your cash. It reduces the amount of capital available. So these things are things you don't have control over. Do you get it?
Yes.
So because you don't have control over them, they will reflect in your financial statement. So we have example type questions. So Twitter provided the following information about current ratio. What will explain this ratio? Current ratio is current asset and current liability.
Ratio.
So current asset here is more than current liability. Current asset here is more than current liability. Current asset is more than current liability. So decrease in cash at bank, decrease in trade payable, decrease in inventory, decrease in trade receivable. What? If your current asset is more than current liabilities,
they all decrease. Wait, I know it's the ratio. Current asset is more than current liability. Means
yes,
it's good. Yeah, but let me think which one. No. Trade receivable.
this is current ratio, you know.
Yeah.
And current ratio is what? Current asset divided by current liability.
Yeah.
So current asset is this, current liability is this. So what does it show you here?
Decrease in trade receivable. Yes.
Is the no trade payables. Sorry.
Receivable.
Current,
The trade payable are in current as a liability, not as.
yeah, your liability, your current assets are more than current liability. That's what it means here.
Yes.
Is trade receivable, decrease in trade receivable. Other questions are long. Except for question 3. Look at question 3.
Yeah.
It says Samira provided the following information at the end of her first year of trading. Trade receivable at the end. The account of the customer Samira could sold on credit was 700. Should be written as an off an income. Off as an income debt. What was the trade receivable turnover?
To have credit.
They said the account of a customer of whom Samira sold goods on credit, 700 should be written off as irrecoverable debt.
Written off.
So the total trade receivable will be what?
Trade receivable will be
3,000, right?
Yeah, 3,000.
3,000 divided by 43,000.
No, not 43.
Credit sales.
38,200.
Oh, sorry, yeah. 3,700 divided by
2,000 divided by
3,000 divided by 38,200 multiplied by 365, right?
yes. 28. 0.6, which is 29 days.
29 days, B.
Yes.
Okay. So I think the rest are long ones.
You'll finish the book.
Okay. Look at number 5.
Number 5.
They said, why may John, a credit supplier, are you there? Question 5.
Yes.
Why may John, a credit supplier, be interested in the financial statement of Paul, a new customer? Why may John, a credit supplier, be interested in the financial statement of Paul, a new customer?
He's interested in the financial
Yeah.
statement. B.
To calculate Paul's trade payables turnover.
Yes.
Thank you. B.
Because they will.
So the answer is B.
Yes.
So that ends the chapter. That ends the chapter and the book.
Yes.